All right, welcome. Life is good. I have my Game of Thrones shirt on, even though there's a Harry Potter background. Like, what is happening? You know what? Quarantine life. It's the second part of our new business series, and we're going to talk about LLCs versus corporations versus sole props, all the things. Partnerships. We're going to talk about it all. All right, let's get started, shall we? So many questions that we get about how should I structure my business, right? Let's start with the legal structure of your business, right? Because there are so many ways to legally structure your business. So you can start when you're, sometimes you guys, businesses just, you run your business under your social, right? You just do work for people and you're an independent contractor and you just collect money under your social and then file it there, right? But if you're actually creating a business of some sort, which from a legal point of view, guys, it's to separate your business from your personal assets, your personal belongings, so that if someone for some reason sues your business or goes against it, they can't go against your personal business or personal assets as well, okay? Not a lawyer, so top level legal structure here, but there's so many ways you can do it, right? You can do you hear LLC, LLP, corporation, PC, PSC, all those different, abbreviations that go at the end of your business. What do they mean? It's just how you have your business set up from a legal structure, and it's how the state recognizes your business, right? So Secretary of State says, oh, you're a PC, which is a professional corporation, or a PSC, a professional service corporation. It doesn't really have to do with your taxing structure, right? And again, for this part of things, consult a lawyer, because I'm not one. I don't know if you guys know that. I'm just an accountant. So consult with a lawyer, because really, you guys, it doesn't have much to do with how you're taxed. And if you look at this first picture that I posted, it tells you guys, so Inc., PC, PSC, LLC, and LLP are some of the most common legal structures. And this little visual tells you where you're going to end up reporting them, or what report you file from a tax point of view. All right, so I am going to go over that just real quick. So what it's saying is you're going to file a Schedule C if you're a sole prop or if you're an LLC. That's when you're one member, that's kind of where it defaults to. All right, and we'll talk about this more in depth. I just kind of wanted to explain this first visual. All right, a 1065 is a partnership. That's the orange. And you're going to file that return. You can be an LLP or an LLC that's taxed as a partnership. And that's the default if there's two or more of you that are starting the business. Those are the two defaults when you set up a business, an LLC, an LLP, anything. Unless you file for a corporation status, that's how it's going to default. If there's one of you, it's going to default to reporting on Schedule C. If there's two or more of you, you're going to default to a partnership and file on 1065. When you originally set up your business, if you elect to be a corporation, which definitely consult your accountant and your legal advisor before you do that, but that's going to default to the bright green, to the 1120. That's the form you're going to file there. Then 1120S is the report you're going to file if you elect S Corp status, and we're going to talk about that in depth. And that can be anything. You can be any type of entity and file for 1120S, file for S Corp status. All right, so we're going to dig into all those things in just a minute. So we talked about all the different legal structures you can be. Well, when all is said and done, there's really only 4 taxing structures for for-profit businesses. All right. I say for-profit because the nonprofit sector, not my jam. But if you're a for-profit business, there are 4 primary taxing structures that you will fall into. So for those of you out there, if you're a disregarded entity, a sole proprietor, a single member LLC, you are going to default to a Schedule C. And let's talk about you first. And if you guys have the links that I posted in this group, open the quick reference chart on the taxing structures, because we're going to go column by column on these and talk about them one by one. All right. So my sole props and my single member LLCs. Okay, this is one owner, sole member, sole prop, one owner. You're going to report your income on Schedule C of your 1040. So when do you pay tax, right? When does your business pay tax? Your business does not pay tax exactly. Like, what happens is your income is reported on that Schedule C that we just talked about, and then you pay your income tax on your personal return. All right, this is a common question I get. They're like, well, how much income tax does my business pay? It doesn't. All right. When you're a sole prop or a single member LLC, actually, if you're anything but a C Corp, and we'll talk about that at the end, what happens is your business is reported some way, shape, or form, somehow flows to your individual return. You pay income tax on your business income on your personal return. All right. We'll talk about each one of these. We'll keep talking about each one of these, but we're talking about my sole props first. All right. So you file, you report your income, your business income on Schedule C of your 1040, and you pay your tax on your individual income tax return, which means that your business income is taxed at whatever your personal income tax rate is. Right? You know how we talk about the marginal tax rates? People say, I fall into the 25% tax bracket. I fall into the 37% tax bracket. All right. Your business income, when you are a sole prop or single member LLC, when you file it on Schedule C, is taxed at the rate of whatever rate you as an individual fall into. All right. You guys with me? Okay. Next, I want to talk about self-employment tax. This, you guys, is where so many people, they get stuck. They don't understand when their tax bill comes why it's so high, because they'll go, well, I fall into the 10% tax bracket. Why do I owe so much money? Because your self-employment tax, all right, is almost 16% of whatever your net profit, your net income from your business is, from your Schedule C. And let's talk about what is self-employment tax. Okay, self-employment tax is how the government gets your payroll tax, right? So when you're a W-2 employee, there's FICA, Social Security, Medicaid, Medicare, you've heard those terms. All right, well, when you're a W-2 employee, you are responsible for paying half. Your employer withholds it from your gross pay, part of why you don't get your full gross pay, right? And then they're responsible for paying half. Well, when you're self-employed, government still wants their money. They still want their portion of their payroll tax. So that's where the self-employment tax comes from. So you pay your FICA through your self-employment tax, and you pay that at the end of the year when you file your Schedule C on your 1040. And then the last thing we want to talk about on each of these tax structures is tax on distributions. What does that mean? So a distribution, you guys, also called a draw, that's the money you take out of the business for your own personal use. All right, so with a Schedule C, with a sole prop, single member LLC, this first category we're talking about, any money that you take out of the business for your personal use, so basically what you pay yourself for working in the business, is considered a distribution or a draw. All right, and that money is not taxed. So how this first category works, and when I'm talking categories, you guys, I am talking about the quick reference chart that is I left it in the comments of this group about an hour ago. Open that up. All right, because that's what we're using as like an outline for this course today. So your business makes money. Let's say they make $100,000 in revenue, right? Then you have all your expenses, everything you pay out for everything. Okay, and you're left with 50 grand. Okay, $50,000 in net profit at the end of the year. All right, you are taxed on that $50,000 as a sole proprietor, whether you take a dollar out or not. Okay, so many people are like, I didn't take any money out. I put it all back into the business. That's fine, but your business still made $50,000, and so you're still going to get taxed $50,000 on $50,000. So that is my sole props. Those of you that file your income for your business on Schedule C. Reminder, if you're not sure which of these four categories you fall into, if there's only one of you that runs the business and you didn't make a corporation, you didn't file as a corporation when you set up your EIN, then you are going to default to this first category, to a sole prop or a single member LLC. Okay? So the next column on our chart is partnerships. All right, and this is the default category if there's two or more of you that start the business. So let's say you and your sister decide to start a business, 50-50, you're going to split all the profits, that's how you're going to pay it out. Great, you file for an EIN, the IRS is going to recognize you as a partnership. Okay, so by definition, number of owners, more than one. Your tax reporting form, you are going to report all of your business activity on what's called a 1065. So you are going to have to file a completely different tax return if you're a partnership. So remember my sole props, you file an additional form on your individual return. Okay, my partnerships out there, you're going to file a completely separate tax return called a 1065. Then what happens, you guys, is that the partnership, the 1065, issues what's called a Form K-1 to each partner. So let's go back to me and my sister. I don't even have a sister, but me and my sister start a business. Let's use those same numbers. We end up with a net profit of $50,000, okay? And we own it 50-50. So our K-1s, each of our K-1s are gonna show $25,000 in taxable income on that K-1 that then gets reported on our individual tax return. Same concept as our sole prop, okay? Our business itself does not pay income tax. All right, when you file that Form 1065, it's just a reporting tool. It's saying, okay, this is how much income the business made, this is how much they spent in expenses, and this is how much income each of the partners is going to report on their individual tax returns. All right, no tax is actually paid with the 1065. So then as a partner, when I file my individual return, I receive that K-1 that tells me how much income I made and how much income I'm responsible for reporting when I file my tax return. And then it's taxed at my individual income tax rate. So then we come back to this daunting darn self-employment tax. All right. So with a partnership, if you're a general partner, then yes, your share of income is going to be subject to self-employment tax, as well as what are called guaranteed payments. Okay. And so guaranteed payments are what the partnership pays you for doing your work in the business. All right, the business might make $50,000 and me and my sister, split that evenly. But let's say I'm working in the business. Okay, I'm doing all the work. I am running the business and she's just maybe investing. All right, well then maybe we set up in our partnership agreement that I'm getting $30,000 a year as a guaranteed payment for my work. Then that is also subject to self-employment tax. If you're a limited partner, then only your guaranteed payments are going to be subject to self-employment tax. All right. And that's all, whether you're a general partner or limited partner, is all set up when you first set up that business. And then we get back to those distributions or draws that we talked about. And are those taxable? And again, no. In a partnership, distributions taken from the business that aren't under those guaranteed payments are not going to be taxable. Unless you take out more than you actually have invested in the business, then that's what's called an excess distribution. And it would be taxes at like your special capital gains rate, but not many people do that. And it's something that if it happens, that's definitely something you and your tax advisor should chat about. But in general, no. Because the reason being, you guys, you were already taxed on that net income, right? So it goes back to how many times I've gotten clients coming and saying, how am I taxed on $50,000? I didn't take any money out. Okay, you're not taxed on the money you take out. You're taxed on the money your business makes. So now, you guys, I want to jump. We're going to come back to S Corp. That's the third column. We're going to jump over to C Corp real quick and you'll understand after we talk about S Corp why we jump over it. So let's go to C Corp. Okay. You can have as many owners in a C Corp as you want. You can have one, you can have thousands. Okay. Pretty much anything. If you look at all those companies that are traded on the stock market, they're usually set up as C corporations. All right, because when you buy stock, you become a partial owner. All right, if you set up your company as a corporation, when you apply for an EIN, if you don't set it up as a corporation, you're going to default to that sole prop or a partnership. But if you say, yeah, I want to be a corporation because I talked to my lawyer, I talked to my accountant, and based on our plans and our goals for our business, a corporation is what fits for us, then you are going to default to the C Corp. It's a regular corporation. You are going to report, the business is going to have a completely different tax form. Again, it's called an 1120. Okay, but unlike the sole prop and the partnerships that we talked about, a C Corp pays its own tax. With the 2018 Tax Cuts and Job Act, that corporate tax rate was set to a flat 21%. So the corporation pays the tax. So if your corporation has net profit of 100 grand, okay, 21% is 21 grand in federal tax. Okay, flat rate. Okay, subject to self-employment tax? No. In this, there is no self-employment tax with a corporation, but corporations are required to pay their officers that are working in the business a reasonable salary. All right, so if I own a C Corp and I'm working in the business, I got to take a salary comparable to what I'm doing. All right, no more, no less. And then we talk about, are you taxed on distributions with a C Corp? Yes. This is where they're called dividends. When you take money out of the business through anything but wages, right? You could pay your wages through a W-2 and that would be normal. But if you take any money out as an investment, like if you take your profits out, then it's a distribution, and they call it a dividend, and it's going to be taxed as capital gains. Okay, and this is where we get that term double taxation. that you hear all the time. I don't want to be a corporation because then I'm subject to double taxation. All right. And what that means, where that term comes from is because we go back, right? So our company, we talked about our company made 100 grand, right, in net income, and we paid 21 grand in taxes on that. Okay. And then at the end of the year, we pay out a dividend. And let's say our business pays me as a shareholder a $10,000 dividend. Then I'm going to get a 1099 div form to file on with my personal return, and I'm going to have to pay tax on that $10,000, even though the business already paid money on that money. Paid tax on that money. All right, that's where double taxation comes into place. So if you're set up in a business where you're going to want to take dividends out, then this is not your best plan. And usually, guys, C corps are really utilized more for companies who are planning to grow big, who want to use source funding or make public offerings. All right, if it's just you, and C corp is not usually the way you go, because there are also a lot of maintenance and legal fees involved with a C corp. So now we are going to talk about an S corp. And S corps, you guys, are my favorite. They're not for everybody, okay, but we'll talk at the end about who they are for, because they are a great tax minimizing tool, depending on how big your business is. So let's start with number of owners. There has to be less than 100, okay? You can't have more than 100 shareholders and have an S corp election. As soon as you go over 100, they kick you to a C corp. Not an issue for most of y'all in here, okay? Tax reporting form. So when you elect S corp status, you elect to be taxed as an S corp, and we'll talk at the end about how you do that. You will file a form 1120S. So again, a completely separate tax return. And like a partnership, the business return will issue a K1 to you as a shareholder. Okay, with a partnership, we call you a partner. With a S corp, we call you a shareholder. And that K1 is going to report your portion of income from the business. Again, like a partnership, you do not pay tax. The business does not pay tax on the business level, right? Remember, it's a reporting instrument, and it relies on that K1 to distribute the income to you as the shareholder to get taxed on your individual return. Here's where S corps get fun. S corps, your income that is reported on your K1 from an S corp, unlike a partnership, is not subject to self-employment tax. Not subject to self-employment tax. However, like a C corp, S corp officers who work in the business must take a reasonable salary. All right. And at the end, as soon as I get through this last piece, we will talk about, I'll give you a mathematical example of when this becomes beneficial and how. All right, but not subject to self-employment tax on your K1 income. And then just like a partnership, you are not taxed on distributions from your business unless you, again, make an excess distribution, meaning you take more out of the business than you actually have equity. So let me take a pause. Cheryl says, that's what I am, an S corp. I love S corps. I love setting them up. We love doing we do tax returns for all entity types, but we definitely have mostly S corps at Lippa Beers and Associates. You guys, let's talk about when you might consider making this S corp status. Okay, because remember, S corp, this is not a legal structure. Okay, this is a tax identification only. All right, so I can't be like, oh, I don't want to be an LLC, I want to be an S corp. No, I am an LLC taxed as an S corp, or my business, Lippa Beers and Associates PC. I'm a PC taxed as an S corp, so I'm a corporation taxed as an S corp. Are you with me? So an S corp is an election you make with the IRS. That's all it is. All right, and it is an election, you guys. You don't have to make it the minute you set up a business. All right, we have lots of businesses who start as a sole proprietor or a partnership, right? And then when they get big and they grow and it makes sense for them to be elected as S corp, we make that S corp election. All right, so you can do it the year you create a business, but a lot of times that doesn't make sense from a tax standpoint. Okay, so it can be done years and years down the road. Okay, I'm so sorry, you guys. My nose itches so bad. I swear I'm not like a Coke fiend or something, but man, it itches. So why would you ever want to be an S corp? So the biggest benefit to making this S corp election is to save on that darn self-employment tax. Okay, if you guys remember, and again, use the quick reference chart if you need a refresher, that if you are a sole prop or a single member LLC, or you're a partnership, then all of your allocation, your portion of income from that business is going to be subject to that 16% self-employment tax. All right, so let's say I am a sole member and last year my net profit was 100 grand. My Schedule C says $100,000. Okay, so I'm subject to my income tax, whatever income tax rate I fell into, and I'm also subject to that extra almost 16% of self-employment tax. So that means I'm paying almost $16,000 in self-employment tax. But if I say, okay, I'm going to be an S Corp this year, and you work with your tax advisor and you determine that a reasonable salary for the work you did, there's a lot of pieces that go into reasonable salary, and we will do a whole entire segment on that after this, after the new business series portion. Okay. But let's say your tax advisor says $50,000 is a reasonable salary for you inside your business. So your business pays a W-2 wage to you. Okay, so you now have a W-2. There's another kid coming down the stairs.
There's no pictures in it.
Yeah, each of these is a chapter, dude. Love you.
Sorry for interrupting you.
Life. All right. #quarantine life. God, that was a really good report too. Okay, so business, $100,000 in net income. Instead of being a C Corp or a Schedule C, we decide to be an S Corp. At that point, we pay ourselves a $50,000 salary. Okay, so the business gets to deduct your salary plus payroll expenses. So let's say that ends up being, for the sake of, let's say it's $55,000. Okay, it's your gross wages plus taxes. Okay, that's not right, just for the sake of making things easier. So now, hi Mike. He has not interfered or interrupted this entire time I've been home. And now, because Travis disappeared. Travis knows better. Travis will get lectured in a minute. So just kidding, he might be on here. So now our taxable income to the business is now only $45,000, right? Because we get to take our officer salary plus any payroll taxes we make. So now our taxable income is only $45,000. And then that is free from self-employment tax at that point. Okay? There's no self-employment tax. So, and then our business issues us as an employee now. We're an employee in our business and we get a $50,000 salary, right? And we're going to pay payroll taxes on that $50,000. The business is going to pay a deductible 50%. We're going to have 50% deducted. Okay? And then so that 50 grand will have payroll taxes paid on it, right? Not self-employment tax, payroll tax, essentially the same thing, right? But instead of $16,000, like when the whole 100 grand is subject to self-employment tax, now we're only paying $8,000 in payroll taxes. All right. We just saved ourselves $8,000 in self-employment tax by making this S Corp election. So the question I get asked so often is, when is it beneficial to be an S Corp? And really what you need to take into consideration is, what is your reasonable salary for you as an officer in your business? And then there's going to be that, unless you're a partnership, if you're a sole prop, you're going to have to take into consideration that now you have another tax return to file and you now have a payroll cost to incur that you have to consider. Okay, so honestly, my answer is, once you figure out your reasonable salary, your payroll expenses, and your additional tax expenses, whatever that number is, let's say it's $60,000, that's your break-even point, really, right? If you're making more than $60,000 in net income, then you're going to benefit from being an S Corp. Do we have people that set up S Corp with less than that in profit? Yes. And it can be done there, but every situation is different. And this is definitely something you want to talk to both your tax accountant and your attorney about. Okay, I am over time by a few minutes. We're going to blame the child because, why not? If you guys are watching this in replay, make sure you let me know, ask your questions, make sure you tag me. All right, if you have questions, so I get notified. And other than that, I think we're good. I will see you guys hopefully on Wednesday. Wednesday is our new kind of training series that we've started. That's more like business topic oriented, so much as financial. And I'm trying to buy myself time so I can tell you what Wednesday's topic is. I didn't buy myself enough time, so I'm looking. I don't know what the topic is. Oh, I do know the topic. I don't need my cheat sheet. We were talking about working remotely and running a team when you're in this remote environment. All right, so that's what we're talking about Wednesday. So I will see you guys Wednesday at 2 p.m. All right, this is the only one that's early. All right. Thanks for joining me today. Thanks, Cheryl. Thanks, Mike. Thanks to everyone else. And again, if you're watching this on replay, make sure you tag me, and I will see you guys on Wednesday. Have a good week.